Did you know that SCHD is considered one of the top dividend ETFs on the market? In fact, Morningstar rated this fund with 5 stars and a gold rating. But have you ever wondered why that is? What makes SCHD exceptional in providing great dividend yield that is balanced with the price appreciation? In this video, I will tackle exactly these questions and provide more insights. Fidelity launched SCHD in 2011, which has since grown to almost 53 billion in assets. The fund holds about 100 stocks and has a low expense ratio of 0.06%. The size of a fund is a significant factor in determining the expense ratio. Typically, the larger the fund size, the lower the expense ratio can be. Also, ETF managers that can engage in securities lending or short sale lending of their portfolio stocks. This allows them to earn more fees and reduce their expense ratios even more. As for the dividend yield, it stands at 3.5% as of February 2024. SCHD is a passive fund that tracks the performance of Dow Jones US Dividend 100 Index. This means that the fund does not engage in active trading or security selections. And this, as we will see in a moment, becomes a crucial factor behind the SCHD's stellar performance. SCHD's primary focus is the quality and sustainability of its dividends. When selecting stocks, the fund takes a pool of potential stocks that excludes REITs. The first selection stage has the following requirements: market cap above $500 million, certain minimum trading volumes, history of dividends for at least 10 years. After this pre-selection, the fund ranks stocks based on dividend yield. Next, SCHD applies additional filters which become very important for its success. The fund ranks the selected stocks again based on free cash flow to debt ratio, return on equity, dividend yield, and a 5-year dividend growth rate. Why is this important, you may ask? Well, it's important because it allows SCHD to identify stocks with a wide economic moat, strong returns, and rock-solid balance sheets. It allows the fund to withstand market downturns with lower drawdowns. In other words, SCHD's portfolio is designed to be defensive in nature, with a focus on dividends, value, and safety. Next, SCHD ranks stocks based on their market cap. Each stock can have no more than 4% allocation. Of course, allocations can get out of whack, and SCHD takes care of that with periodic rebalancing. Upon examining the top 10 holdings, it becomes clear why the fund has been so successful. Companies such as Broadcom, Merck, Home Depot are cornerstones of SCHD's portfolio. One note though on concentration. Compared to other dividend ETFs, SCHD has a somewhat higher concentration at the top, and overall it tracks smaller number of stocks. Such higher concentration at the top allows it to amplify its returns or losses, so it's kind of like a double-edged sword to keep in mind. As for the sectors, the fund caps their allocation to no more than 25%. Companies in healthcare, industrial, and financial sectors account for almost 50%. Next, let's understand SCHD's performance and various factors behind it. First, SCHD's portfolio has a higher ROC and lower price to free cash flows compared to its benchmark. This indicates that the fund's holdings have a value tilt. SCHD's portfolio consists of many stable cash flow companies that can sustain growing dividends. But this comes at the expense of a somewhat lower price appreciation compared to, say, S&P 500. ROC stands for the return on invested capital. It indicates how efficiently a firm uses its capital to generate profits. A higher ROC is better because it shows that a firm can generate higher profits with less capital. Price to free cash flow is another important metric. It indicates how the market prices a company's free cash flows that can be used to, say, pay dividends or meet its financing or investing needs. Typically, a lower price to free cash flow indicates a bargain from the investor's point of view, but not always. Next, let's take a look at the performance of SCHD. We see that SCHD outperformed its counterpart by almost 2 to 3% for 5 and 10-year time periods. Even if we compare SCHD to S&P 500, the fund still stayed competitive. True, overall, SCHDs underperformed the S&P 500. But considering its value tilt, SCHD did well for itself. Of course, investors should not always count on such strong performance, and yet it shows how robust SCHD's portfolio is. As for the risk-adjusted returns, SCHD did well too compared to the Russell 1000 Value Index. The fund was not too far off from S&P 500 on a 10-year basis either. This is again quite impressive. If you have watched my previous videos on ETFs, you probably know that I'm not a big fan of risk-adjusted returns. The key question to ask is, what is investment risk? To me, investment risk is the probability of a permanent loss of capital. But this is not what the risk-adjusted returns measure. Instead, they rely on volatility as the proxy measure for risk. And I think it's a poor metric to rely on for investment decisions. If you can tolerate volatility and wait it out and get higher returns, it doesn't really matter how you get there. Of course, fluctuating prices, they pose their own unique risk, known as a sequence of returns risk. It has to do with the timing of selling your portfolio securities to fund your living expenses. If you must sell, let's say, in a bear market, your overall portfolio return will be much worse. But if you can wait it out, this risk largely disappears. So I understand why volatility can be a consideration for someone. In my next video, I will compare SCHD to another popular dividend ETF from Vanguard called VIG. So stay tuned for that and subscribe to my channel. Thanks for watching.